Good morning, everyone. Welcome to the batch on CA final coaching. I suppose this is the first batch for the new syllabus. Though, as far as your financial reporting is concerned, there is no major changes which you will see. Okay. So, today is going to be a discussion on the conceptual framework for financial reporting under the Indian accounting standards, or the Ind AS that you have that you will now be studying. Okay. So, good morning, Vanshika. Good morning, Mansha. Good morning. Okay. So, we start with conceptual framework for financial reporting. This is a mere framework for how to present my financial statements. It is not an Ind AS by itself. It is a mere framework. Though it is a mere framework, I have to say that it is actually the base on which your Ind ASs are laid down. It is a base for the standard setters to draft a particular standard, to draft a particular provision in a standard, to ensure that the requirements of the framework are met. Sir, is it mandatory to follow the framework? As far as possible. As far as possible. Sir, can I have cases where an Ind AS deviates from the framework? Yes. Sir, when an Ind AS and the framework has a conflict, what do we follow? We will be following the specific Ind AS in that case. Okay. So now, considering all these factors, we now delve into the topic proper. So what do we mean by a framework? What do we mean by a framework? And why do I need this? Okay. So, when I say framework, I mean it is a statement of generally accepted theoretical principles which form the frame of reference for a particular field of inquiry. Okay. So this is the meaning of only a framework. Okay. I'm not talking about financial reporting framework as yet. A framework is basically a statement of generally accepted theoretical principles. Means what? It means, if I'm taking the example of financial statements because that is what we are going to do. But as of now, when I say what do you mean by a framework, I specifically mean that if I have to prepare the financial statements, what is an asset? What is a liability? When will a particular item be classified as an asset? What do you mean by income? What do you mean by expenses? What do you mean by equity? All these are broadly defined in the conceptual framework for financial reporting. Okay. So based on these guidelines, classifications arise as assets or liabilities, whatever the elements of our financial statements. Okay. Am I not audible? Hello? Am I audible? Students, please confirm, am I audible? Deepak is saying I am not audible. Audible? Okay, fine. All right. So now, okay, I'm audible, Deepak. You can check from your end whether there is any issue. Okay, all right. Now, the financial reporting framework. Now, this is coming to our particular financial reporting. The financial reporting framework is basically a theoretical basis for determining which events should be accounted for, how they should be measured, and how they should be communicated. So when I talk about which events should be accounted for, I will basically be discussing the recognition of the same. I will be discussing the recognition of the same. How they should be measured. So here I am talking about measurement. Deepak, all the students have confirmed that it's audible, okay, and visible as well. So you can just have a look once again at your sound systems. how they should be communicated to the user. So this is your disclosures. So the framework gives a theoretical understanding of how the recognition should happen, how the measurement should happen, and how the disclosure should happen. So does it mean it will specify disclosure for each Ind AS? No. Respective disclosures under each Ind AS are covered in those Ind ASs only. But those disclosures broadly follow the guidelines given in the financial reporting framework. What about measurement? The nitty-gritties of the measurement is given in the respective standards. But here we are given a broad outline, like there is something known as a fair value measurement. There is something known as a historical cost basis of measurement. So just a guideline of that is given in the financial reporting framework. But whether I have to use a revaluation model for property, plant and equipment, or whether I have to use a historical cost model for property, plant, equipment, which financial instrument should I fair value? That is not covered under the financial reporting framework. That is covered under the respective Ind ASs. Okay. So when I talk about the framework, as I mentioned earlier, the framework itself is not an Ind AS. It is not an Ind AS, and it does not define any standards for particular measurement or disclosure issue. That means what? You cannot treat it as an Ind AS. At times, you may deviate from the framework and yet follow the Ind AS. So that means you have complied with the requirements of the Ind AS. The framework does not override any specific Ind AS. What do you mean override? Suppose you have a requirement in a particular Ind AS. We'll come to that in a short while, but in brief, I will just explain to you. Suppose you have something known as an intangible asset. All of you would be aware of it. So intangible asset is basically assets which you cannot see, which you cannot feel, which you cannot touch, but they exist, like patents, trademarks, copyrights, landing rights at airports. All of these are my intangible assets. Now, under the framework, the framework defines an asset as an item that is giving us a potential to have cash inflows in the future, to have inflows of economic benefits in the future. That's it. The framework does not tell us whether we have to look at the probability of those inflows. For example, you have a debtor which and that debtor went into insolvency. So technically speaking, you do not have an asset because the likelihood of realizing of that debtor is extremely remote. But the framework tells us no, we are not going to discuss about whether the probability is remote or whether the probability is whether it is more probable or remote. That is not covered under the framework. Is there a potential to receive economic benefits in the future? Yes. So that becomes an asset. But when I look at the definition of intangible assets under Ind AS 38, the definition of intangible assets tells us that it can be disclosed as an intangible if and only if the probability of economic benefits arising is high. It is probable. It is more than 51% sure that you are going to get economic benefits from that. So a probability is attached to recognition of an intangible asset, whereas in the framework, there is no probability criteria. So clearly, there appears to be a conflict. There appears to be a lock. Framework says probability is not required of realizing the cash flows. As long as you have a potential, it becomes an asset. But the intangible asset standard tells us that as long as you are having an asset with a high probability of realizing the cash flows, only then you can recognize the intangible asset. There is a conflict. So in this conflict, what prevails? Clearly, Ind AS requirements will prevail. But If that is the case, you will ask, sir, तो फिर framework लाने का मतलब क्या है? जब ultimately Ind AS के हिसाब से ही चलना है, ultimately we have to follow the Ind AS, then what is the purpose of the framework? The framework gives guidance. The framework gives set of rules, set of principles that need to be followed. You have to understand that Ind AS, Indian accounting standards, are modeled on the IFRS, the International Financial Reporting Standards. Okay. So these are not rule-based standards. These are not rule-based standards. These are principle-based standards. What do you mean by rule versus principle? Principle means you can choose to follow multiple options which are given in the standards. And those multiple options given in the standards give you the flexibility to select and follow a particular option. If you select a particular option, you can give disclosures about why you selected that option. So this flexibility is given in the IFRS. The rules-based framework is more common in the United States, where there is a rule for every item that needs to be reported. If there is non-compliance with the rule, then your financial statements will not meet the requirements of the reporting standards in the United States. So this is what is the difference between the reporting framework. So in terms of the flexibility that is given to the preparers of financial statements, it is extremely high under the Ind AS regime. Okay. So that is why, though Ind AS could conflict potentially with the framework, it is acceptable because the framework is merely a set of principles. It is a set of generally accepted theoretical principles. Okay. And therefore, this framework need not be strictly followed in the Ind AS. Broadly, they have been, but some small places you have certain clauses which appear to deviate, but it is only to enhance the financial reporting. Okay. So with that, we proceed further. So what is the purpose of the framework? The framework describes the objective of the concepts for general purpose financial reporting. General purpose financial reporting. So it has a threefold purpose. It assists three people. One is the institute. Second is the preparers of financial statements. That means the companies to whom Ind AS is applicable. And third one is the residual category, that is all parties. So what benefit or what purpose does it serve for the Institute of Chartered Accountants of India? Well, it assists in formulation of the Ind AS that are based on consistent concepts. So that is why we are having this particular requirement. Okay. So when you have standard setters who are going to set certain accounting standards, they cannot merely set an accounting standard at a meeting and they come out with the AS. No. They have to keep in mind the principles of the conceptual framework. And as far as possible, the standards which are set should be in line with the conceptual framework. In case of deviations, they will mention the reasons why they have deviated. When it comes to preparers, it assists the preparers to develop consistent accounting policies when no Ind AS applies to a particular transaction or event, or when an Ind AS allows a choice of accounting policy. Okay. What does it mean? So suppose, for example, you are a manufacturing entity and you have to do valuation of your inventory. Now, your valuation of inventories could be either based on the FIFO method or the weighted average method. So these measurement bases are prescribed under the Ind AS 2 standard on inventories. But the option that you want to avail, the fact that you have an option, that fact comes from the financial reporting framework. It tells us that there could be a case where multiple measurement bases could be allowed, and the preparer of financial statements can select any one measurement base and do the financial reporting, and he will still be considered to be in compliance with the framework. And the Ind AS also permits you to follow either FIFO or weighted average, or in the case of property, plant and equipment, either revaluation model or the cost model. That multiple measurement basis is given where the fact that you can have multiple measurement basis is given in the financial reporting framework. Okay, so it assists the preparers in either it assists the preparers to develop consistent policies where no Ind AS applies, or when an Ind AS allows a choice of accounting policies, you be as consistent as possible. And all other parties, who is neither the institute nor the preparer, remaining all, it assists to understand and interpret the Ind ASs. Okay, so far is it okay, everyone? Yes, are you guys comfortable? Please feel free to ask questions. Okay, are you comfortable? It's the first class, so you will need a couple of minutes to ensure that we be on the same page. So are you guys clear? Good morning, Pooja. Hello, Vishal, Mohammed, Rajiv. Good morning, everyone. Yes. So all clear so far? Okay, fine. Thank you. Thank you, Vanshika. Thank you, Tanisha. Let us proceed further. So what is the objective of general purpose financial reporting? I hope you understand that general purpose financial reporting is basically the reporting that we see, that you prepare, that you audit. That means it comprises of the balance sheet, the statement of comprehensive income, the statement of changes in equity, the statement of cash flows, and finally the notes to accounts. So these are my general purpose financial statements. So what do I mean by the general purpose financial statements? It caters to a large number of users. It caters to a large number of users. So general purpose is one. So sir, general का opposite होता है special purpose. So do I have special purpose financial reporting? Yes, I do. I have special purpose financial reports. For example, a due diligence report. A due diligence report. Tata's took over Air India. So before they took over Air India, see, when they are taking over an entity, they have to pay the purchase consideration. Okay, so if they have to pay the purchase consideration, they should be able to satisfy themselves about what is going to be the value of the entity which they are acquiring. Very simple. If you are going from place A to place B, say by auto rickshaw, you are probably aware of what should be the maximum fare that you can pay. And then you can bargain and negotiate at a price. Similarly, when I am acquiring an entity, I should be aware of all the facts, right? So what Tata's would have done, they would have appointed certain consulting firms. These consulting firms would perform a due diligence of Air India. What do you mean by due diligence? They would look at all the items which are reported in the financial statements, as well as possible claims, possible assets, possible items which are not present in the balance sheet. Contingent liabilities, for example. They will give that information to the Tatas. And based on that, a purchase consideration would be negotiated between Tata and the owners of Air India. That is the government. Okay. So this was how the process happens. Now the due diligence report which the consulting firms prepare in respect of the target entity is only and only for the use of Tatas. It is not going to be published. It is not going to be made available to the public. It is exclusively for the use of Tatas. So we cannot call that as general purpose financial statements. We call that as special purpose financial statements. So the reporting framework and the entire Ind AS are dealing with general purpose financial statements only. They do not deal with special purpose financial statements. Special purpose statements, the content, what is expected from that is going to be given in the engagement for the purposes of the special purpose financial statements. Is it okay? So when I talk about general purpose financial reporting, what is the objective of that? Well, the objective of that is to provide financial information which is useful to existing and potential investors, lenders, and other creditors. Why? Because it assists them in making decisions relating to providing resources to the entity. A lender gives loans to an entity. A creditor gives goods on credit, and investors obviously make investment in the company. So all these three categories, they give what we call resources to the entity. So whether they should give resources or not, that is decided based on the financial information published in the general purpose financial statements. Okay, so that takes care of the objective. So if I have to look at the process, financial information about the economic resources of the entity. So when I say economic resources, it will come ahead, but economic resources typically means assets. Claims against the entity, this typically means a liability, and changes in those resources and claims. So a comparative statement is given, changes in those resources and claims. That is one. And changes will also mean the resources and claims change will ultimately give rise to either an expense or an income, as the case may be. So it covers your statement of comprehensive income as well. Assessment of the amount, timing, and uncertainty of future net cash inflows to the entity and management's stewardship of the entity's economic resources. Okay. So it helps in assessment of the uncertainty of the future net cash inflows. So based on the cash flows and the profitability statement and the economic resources and claims, you can kind of assess how is the entity going to operate in the future. Take for instance a cash-rich, cash-generating entity. Do you think it will have lot of cash flows from investing activities which are negative? No. Which are positive? No. It will have a negative investing cash flow because it is expanding, it is growing, it has the cash, it is making more and more investments. Its revenues are increasing, it is setting up new plants at various locations. So you as an investor can clearly assess that, yes, this appears to be on a growth trajectory, on a growth path, and therefore it is comfortable for me to invest in this particular entity. Contrast it with an entity that is having a lot of positive investing cash flows. That means it is selling off assets to run the business. So when it is selling assets to run the business, what does it mean? It means that it is not able to sustain, it is not able to continue, it is not able to meet its obligations without selling off its assets. It is required to meet the obligations. It is required to meet, it cannot meet the obligations from the operations only. It is going to have to resort to sale of assets. So in such companies, probably I can say that the future does not appear to be as good as it should be. Okay. So based on that, the investors will then take a call whether they should invest or they should not invest. So it gives an assessment of the amount, timing, and uncertainty of future cash flows to the entity and management's stewardship of the entity's economic resources. Have you heard this term management stewardship? Yes. Have you heard this word? थोड़ा भारी अंग्रेजी है. Yes. But have you heard these words? Management stewardship. Yes. Have you heard management stewardship? No. Krish, Krishna, Krishna Swati. Yes. Are you there? Tanisha, Vanshika, Ashu. Okay. All right. Fine. Now, let us suppose that you are having shares in Reliance Industries or any company. I'll take Reliance as an example. Let us suppose you have invested your money in the shares of Reliance. Now, you are an investor. You are an investor. सर इन्वेस्टर का मतलब होता है ओनर ऑफ द कंपनी. लीगली स्पीकिंग यस. लीगली स्पीकिंग यस. सो इफ यू आर एन इन्वेस्टर, does it mean you are an owner of the company? Yes. The company owns its assets. The company has assets in its name. So do you think that you are the owner of Reliance? Reliance has assets. So do you think you can take a stake on those assets without the company going into liquidation? Let me make it more clear with an example. Reliance has a private jet. So, suppose you want to travel from Bombay to Delhi on an urgent basis. Do you think you can go to Reliance Industries head office in Bombay, in Nariman Point, and tell them, I'm your shareholder, please arrange your chartered aircraft for transporting me from Bombay to Delhi because I am a shareholder, ultimately I own the aircraft. Do you think you can do that? Answer is no, you cannot. There is a separation between you as the investor and the management. There is a separation. You are giving your money to Reliance. Reliance carries on activities with that money. That does not make you a claimant on those assets. The management is going to have to utilize the money collected by you into meaningful businesses and generate a profit and give that return to you. As long as the entity is operating as a going concern, as long as the entity is functioning as a solvent entity which typically may have a positive net worth and a good profit, you as the investor can have a stake only on those profits, that also provided if dividend is declared. Can the shareholders voluntarily go and declare the dividends? Answer is no. It is the board of directors who propose and then the shareholders accept it. Most of the cases it is always acceptable. But ultimately the fact is your money reaches the management and management manages those resources based on the money that you have given to them. That process of managing the resources, putting it in businesses, generating the profit on behalf of the investor, we call that as management stewardship. What do we call that? Management stewardship. Okay. So for example, you have investors who are the owners. You have the company Reliance Industries and you have the management. The management runs the company with the resources and the management is responsible for those resources. Suppose a factory catches fire because of negligence on part of the factory management. Who is responsible for that? Whom are you going to question? You are going to question the management only. Why am I going to question the management? Because there is a fiduciary relationship. Fiduciary सुना है आपने? Have you heard the word fiduciary before? Fiduciary का मतलब होता है trust. You trust Mukesh Ambani and that is why you are putting your money in Reliance Industries. You trust Sunil Mittal and that is why you will put your money in Bharti Airtel's shares. You are going to trust XYZ and that is why you put your money. Many of you would have watched this show that is called a Shark Tank. In Shark Tank, what happens is you have a lot of investors who come on the platform, and you have these budding entrepreneurs who make their pitch and take the money from the investors if the investors feel it is a viable option to invest. Now, the investors, those sharks who are seated on the panel, whom I call investors, they give you the money. So you are going to you are entering into a fiduciary relationship with the investors. And that money which you receive, you are going to use it on the resources, manage it. Ultimately, you as the management will be accountable to the, what you can say, to the investors. You will be accountable to the investors. The investors can question you on anything and everything. They can question you on why you bought a particular asset, why you invested in a particular business, what is the profitability of that, why are you investing here, why not there, what is the future of this, what is the past trends, how are you performing now. All these questions the investors have a right to receive answers from you, and you have a duty to give those answers as the management. And that is why we call this as a fiduciary relationship, a trust, a relationship based on trust. Today when you put money, you are sure it won't, वो पैसा डूब नहीं जाएगा. Yes, आपको भरोसा है उस पे. So that we call as a fiduciary relationship. And this responsibility towards the resources is known as stewardship, okay. So that takes care of this part, okay. Assessment of the amount, timing and uncertainty of future cash inflows, and management stewardship of the entity's economic resources. So this is, and then which ultimately leads to an expectation of returns, which could be either dividends or repayment of principal or interest repayments, etc., which enables investors to take decisions, investors, lenders, and other creditors. So the financial information coupled with assessment of future net inflows and the stewardship of resources with an expectation of returns is ultimately going to be the basis on which the investors, lenders, creditors, etc. are going to lend resources to the entity. Okay. General purpose financial reporting comes with its own set of limitations. So today's session is going to be largely theory. Okay. There is no major sum as such. Okay. It's going to be a theoretical session, not a very long one. We will be able to complete well before time. Okay. So when I talk about general purpose financial reporting, what are its limitations? So first one is, they do not and cannot provide all the information. They do not and cannot provide all the information. Those users need to consider pertinent information from other sources. For example, general economic conditions and expectations, political events, political climate, industry and company outlooks. Okay. So for example, we had cases where group entities, multinational companies, this has happened in one of the areas where I was working. So the Russia-Ukraine conflict has put the European Union into a disarray. It has put many things apart. So one of the companies where I was working, it was a multinational company. So they had a machinery that was situated in Poland, and they wanted to transfer that machinery from that country to Russia for operations in Russia. Now, Russia-Ukraine conflict was going on. So the transactions between European Union and Russia were barred. There was a limitation. We had an entity in India for the multinational company. So what was the overall transaction? the Poland entity sold it to the Indian entity, and the Indian entity then sold it back to the Russian entity. So we have become a conduit for transferring that. This information is not going to be provided directly in the general purpose financial statements. You can see that machinery has come, machinery has gone in the balance sheet. In the balance sheet, what are you going to see is an inward and an outward. For all I know, it is a mere trading activity for us. So in the profit and loss account, you will see purchases, and in the profit and loss account, you will see sale of machinery. Why this is done? Do you think they will mention to you? They won't. It's not required to be mentioned. That's what I'm saying. Nothing wrong is being done by hiding it or by not disclosing it. Why? Because it is a general purpose reporting. The Russia-Ukraine conflict has given rise to certain political, what you can say, encumbrances, and as a result, transactions will not flow in the normal manner in which they should flow. But that becomes a specific information, and that specific information may not be given in the general purpose financial statements. So therefore, there is a limitation in respect of what is the information that you are going to receive from the general purpose financial statements. कुछ information आपको दिया नहीं जाएगा क्योंकि वो general है, specific, क्योंकि वो specific है, general नहीं है. Is it okay? Yes. So information provided. Next one is value. Do you think from the balance sheet you can assess the value of an entity? Answer is no. For purposes of assessing the value, to value the shares of your company, what all you need is what is the future assessment of revenues, what is the future assessment of costs, cash flows. You will extrapolate the cash flows to the next 5 years, 7 years, 10 years, and then you will use a discounting factor and bring the cash flows to the present value, and that is going to be the basis for your valuation. But is this data, future cash flows, discount rates, आपको क्या लगता है? Do you think this data is given in the general purpose financial statements? Answer is no, it's not. So therefore, GPF reports are not designed to show the value of a reporting entity. But yes, they do provide assistance in estimating the value of the reporting entity. They do provide assistance. You can look at the past trends, and then you can construct a financial model to determine the value of a particular entity. So that past trends are coming from where? It's coming from general purpose financial statements. So if it is coming from general purpose financial statements, it is merely assisting you to arrive at a value. But apart from that, there is no other data that can give you the value of the particular entity. Suppose, for example, you have a company like Unilever, which is setting up its plant in Egypt. Now, if Unilever is setting up a plant in Egypt, do you think the financial statements will tell you what are the possible cash flows from the Egypt project? Answer is no, that they will not be telling you. Though in the management discussion, they are going to give you, in brief, they will tell you we expect so many volumes of our products to be sold. We expect these would be the costs. We expect an inflation of so much in Egypt. So all this data is going to be given in the value, but is going to be given in the general purpose statements. But that is not going to directly tell you that Unilever's value today is 2,975 rupees per share. No, that data is not going to be given in the financials. Okay. Now, coming to the next one, users. GPF reports are not primarily directed to other parties, such as regulators, members of the public, etc., other than investors, lenders, and creditors. Okay, ठीक है. So this is what is the limitations of general purpose financial reporting. Okay, sir, ESG compliances sustainable reporting can overcome the limitations of general purpose reporting? Answer is no. Again, to tell you, sustainability standards, environment, social governance reporting, ESG reporting, these are again meeting only specific requirements to what is the sustainability goals of the entity, how is the governance structure, what is the entity doing for the environment. These are all very general in nature. They will not add value. They will not give you much of the information that you need. In fact, I normally reserve this for the last day of my class, but since the topic is opened up, there is a lot of discussion on ESG. Okay, there is a lot of back and forth which happens. There are a lot of people who advocate ESG and sustainability reporting, and on the equally other side, there are a lot of people who are against ESG and sustainability reporting. Very simple question. What the people who oppose ESG is, what they ask is, do you think by giving an ESG report, by giving an environment, sustainability and governance report, do you think the value of the firm is enhanced? Do you think value of the firm is enhanced? What do you think? An ESG report. Suppose you have Unilever, which gives a report saying that these many carbon emissions it has offsetted with plantation of trees. This is its governance structure. This is the sustainability model. In the next 5 years, it proposes to remove all one-time plastic and move to a recyclable plastic. All this information comes in ESG. But tell me, does it mean the company becomes more valuable? I will come down to the threadbare question and ask you, you are planting trees, offsetting the carbon emissions that you generate. You are excellent corporate citizen. You have lot of activities for the underprivileged, for the society. Your contributions cannot be matched. But when you go to take a loan from a bank, do you think the interest rate that the bank will offer to you will be less merely because you planted more trees? Answer is no. It will not. The banker who gives you the loan is going to look at only and only your financials. And that is the basis what opposition to ESG reporting state. When I say interest on loan, I gave a simple example, but basically what I'm trying to say is it is nothing but the cost of capital. Is your cost of capital going to change because you are a good corporate citizen? Answer is no. Is your cost of capital going to change because you planted more trees and offset the carbon emissions? Answer is no. Is your cost of capital going to change because you are moving from one-time plastic to recyclable plastic? Answer is no. They are dependent solely and only on financial indicators and nothing else. So does it mean a corporate entity should stop doing these things? No, they should do it. No harm in that. But the oppositions to the ESG say that, what is the need for ESG in that case? You do it silently, work on it. We are there with you, but there is no need to come out with ESG reporting and standards and this and that, because one, it's not easily quantifiable. Two, it is not comparable. Three, it is not consistent. Four, it is not adding any value. So when all these things are there, the oppositions to the ESG say that when none of these things are satisfied, why am I going behind a reporting scenario which probably is not going to add any value to the entity? That is their picture. So this is how it is. Okay. So it won't enhance the confidence of the shareholder just because an entity is doing a good job. If an entity does a good job but if an entity plants lot of trees, does lot of social activity, But on the financial side, it is a loss-making entity. Are you going to invest merely by saying that "Nahi, this company is doing a good social responsibility"? No, you won't. You will look at the sustainability of that entity in the future. Are bhai, are you going to survive? That is the first question you will ask as a shareholder. And that is why you have these oppositions. So to conclude, ESG compliances, etc., will not meet the limitations of general purpose financial reporting. That is a separate reporting altogether. Okay, that is a separate reporting altogether. Okay, yes. So when we talk about protecting the resources, I am very much in favor of that. Companies have corporate responsibilities. If they are generating emissions, it is their bound duty to neutralize those emissions. I am absolutely for that. But getting a report and consultants and the whole ecosystem that is being created out of that, it's not serving ultimately any purpose. Okay, so that is done. Next, now what is the information provided by general purpose financial reports? Okay, let me look at Vimal. Yes, it is referred by statutory authority like revenue officers or regulatory body. Yes, general purpose financial statements are viewed. So in this case, they have said that it is not primarily directed to regulators. That means the financial statements, do you see a statement like to the income tax department and then the audit report follows? No, it's directed to the members and then the whole process starts. So the reporting happens to the investors primarily. The lenders and creditors review it, but it is not to a particular regulatory body or to a particular what we can say. We don't report to SEBI, we don't report to income tax specifically. They use it, but it's not meant for them specifically. Okay, so that is what is the meaning of the last bullet. Okay, so coming to the next one, information provided by general purpose financial reports. What is going to be given is financial position and effects of transactions and other events that change the entity's economic resources and claims. So for example, you have economic resources of the entity, that is assets, and claims, that is liability. So in the balance sheet, you give the assets and liabilities position. Changes, you give the statement of comprehensive income, that is the profit and loss, that is your financial performance. Cash flows, you give that, and changes not resulting from financial performance. So you could be having the statement of changes in equity here, where contribution or infusion of capital is there, buyback of shares are there, or third case, you could also be having dividends declared. So all of that is going to come from here. So your financial information broadly gives you idea of assets, liabilities, cash flows, profit and loss, and statement of changes in equity, coupled with notes, of course. Okay, so now what do I report? What do I report? Well, you are going to report resources and claims. That means this is your balance sheet. Same thing, I have just put it in small points. You are going to put in changes in economic resources and claims from financial performance and other events like issue of debt or equity. Financial performance reflected by accrual accounting. We all know what accrual accounting is. And performance is reflected by past cash flows. So these are the objectives of general purpose financial statements. In that, what needs to be reported. So that is why when we are doing our annual reporting and preparing our financial statements, they stick to only these items. They stick to only these items with notes. Okay. So now coming to the qualitative characteristics. What do you mean by qualitative characteristics? What should be, or what should be the features that make financial information useful, that provide value, that give information, that add an understanding, that add a layer of clarity to the reader of the financial statements. What are those features? So they are classified into two parts. First one is relevance. Second one is faithful representation. So these are fundamental characteristics. Can I avoid the fundamental characteristics? Answer is no. This is mandatory. Your financial statements should present information that has relevance, and it should faithfully represent it. When I say faithfully represent, what do you mean? Sir, it should be complete. Nothing should be eliminated. It should be neutral, supported by exercise of prudence, and it should be free from error. So when I talk about relevance, what do you mean by relevance? I'll just take you to the next page and we can understand. When can an information be said to be relevant? It is if the information with predictive value or confirmatory value or both makes it capable of making a difference in decisions made by the users. If both these things are met, it becomes relevant financial information. Sir, ये तो ठीक है, सरल भाषा में समझाओ. Explain it in an easy manner. So basically, financial information with predictive value. So you are given the profit and loss account, you are given incomes, expenses, etc. segment wise. For example, again, we take a company like HUL. Okay. Now, I'm just making this up. HUL could be having various segments. Segments like what? It could be having oral care. It is manufacturing toothpastes like Pepsodent, Close-Up, etc. So you could be having oral care. You could be having skin care. Yes. Like Glow and Lovely, cosmetics, etc. You could be having detergents. Yes. I think it is manufacturing Surf Excel probably. Yes. So you could be having detergents. Then you could be having body care like soaps, etc. This Unilever only manufactures. It could be having this is body care. Then it could also be having now the food segment. It has taken over GlaxoSmithKline. So basically your Horlicks and all that comes in here. So you would be having food products. Okay. Packaged food. Okay. So these are some of the segments where Unilever is operating. Okay. I'm making this up. It's not exactly as per the financials. Okay. So now you will be seeing a trend of how the oral care products have been performing, how the skincare revenues are growing, how the profitability of detergents is getting affected, what is the body care's future, and how are the food products performing. So all this data is going to be given segment wise in each financial statement. Now, is that going to be giving a predictive value? Answer is yes. Oral care is showing a 5% growth rate or a 10% growth rate every year. Suddenly in 2017 or 2016, for example, you had a competitor who entered the industry. Take for example Patanjali. Patanjali entered the industry. Now, if Patanjali entered the industry, it is cutting into the revenues of Unilever to some small extent. So now, your predictive values will show the fact that past years, the rate of increase of oral care was 10%. With the advent of Patanjali, current year, the revenue growth has been only 6%. So 10 to 6. So in the future, when you want to analyze the profitability of Unilever, which percentage are you going to take? Are you going to take 10, which has been the pattern till now, or are you going to 6, which is the scenario after the coming of Patanjali? Obviously, you will be taking 6. So therefore, this is facilitating a future model. This is giving a future predictive value. So that is going to be relevant information. That is going to be relevant information. Secondly, it could either be giving a confirmatory value. Last quarter, you had carried out an analysis. In the analysis, you gave your estimate of revenue, you gave your estimate of costs, you give your estimates of finance costs, and you give your estimates of the profit. So when these are the cases, when this data is given, my question is, can I compare this analysis with the actual data that is now flowing in? Answer is yes, you can. And that comparison will give you certain variations, what we call as variances. So basis those analysis, can I modify the predictions which I made earlier to include any new data that has come in? Answer is yes. And can this be achieved from the general purpose financial statements? Answer is again yes. So I'm getting a predictive value on one side, where I can make predictions of the future, which is what analysts do. वो करते क्या है analysts? They pick up a company, look at its revenue, plug it in their model, look at the cost, look at the expenses, arrive at a particular metric, an EBITDA metric, for example. Okay. So now this is what they arrive at, and then they estimate that Unilever's price could increase or it could decrease based on this data, and they give a buy or sell indicator. Okay. So this is your predictive value. Once the actual numbers flow in, can I get a confirmatory value? Of course you can. Of course you can. Okay. So that is how you are going to view it. That is how you are going to view it. Now, predictive plus confirmatory together helps me, the investor, to make a decision. Okay. It can also impact my decisions. It can also impact my decisions. So this plus the second block together becomes relevant financial information. So what is the thing is that it has predictive and or confirmatory value. Consider materiality. Obviously, you cannot let go of materiality. For a company like Unilever, if your variations come to even about a couple of lakhs or a couple of crores here and there also, it's not going to make a major difference. Okay, so qualitative characteristics of useful financial information. That is the relevance part that we dealt with. That is the relevance part that we dealt with. Okay, so go through this for homework. This is the example that is there. Yes. Anybody has any doubt so far? Have you understood relevance totally? Have you understood relevance totally? बोलो. Relevance समझ में आया अपने को? Yes. Tanisha, Vimal Kishore, Krishna Swati, Mansha, Vanshika, Deepak, Mohammed, Shankar, Pooja, all clear so far? Yes. Shruti also confirmed. Okay. All right. Okay, fine. Good. Okay. So go through this just example one. It's very simple. I don't have anything to do. Coming to the next characteristic, that is faithful representation. A representation reflecting economic substance rather than a legal form. Okay. So now let us take an example. Okay. When I give you an example, okay. All right. Suppose, let me give you an example. Confirmatory value is basically आपने जो पहले predict किया था, the latest set of information is going to confirm whether your predictions are right, whether your predictions are wrong, and whether you need to change those predictions. उसको हम लोग बोलते हैं confirmatory value. We call that as confirmatory value. आपने predict किया, then you have to compare with what is the actual, na? So that is why we call that as confirmatory value. Okay. Coming to the next one, faithful representation. Coming to the next one, that is faithful representation. You reflect the economic substance rather than the legal form. Let me ask you a question. You should be able to answer this. A Limited enters into a transaction with B Limited. Okay. A Limited enters into a transaction with B Limited. Transaction क्या है? A Limited has finished goods worth 1 lakh. So what A Limited does is, A Limited sells goods to B Limited at 1 lakh. And at the time of entering into the agreement, it is also mentioned that he will purchase those goods from B Limited for rupees 1.1 lakh. So this is the transaction today, 1st April 23. And he said that he will purchase those goods back on 1st April 24. I want you to look at the example, the question which I have asked, and tell me what entry A Limited is going to pass in its books. What entry A Limited is going to pass in its books. I hope you understood. 1st April 23 sells the goods for 1 lakh with a condition that on 1st April 24, he will purchase those goods from B Limited, for rupees 1.1 lakh. For rupees 1.1 lakh. What do you think will be the entry that is to be passed? Come on. Where is everyone? Charu, Shailesh, Ashu, Vanshika, Tanisha, Vimal, Rajiv, Krishna, Swati, Mansha, Mohammed, Deepak, Vishal, Viraj. First April 23 sold goods for 1 lakh. 1st April 24 purchased those goods only from B Limited for rupees 1.1 lakh. What is the entry that you are going to pass? Okay. I'm happy you are thinking on similar lines, Tanisha. Just give me a minute, please. Yeah. Okay. Okay. All right. So 2 to 3 people are finding it a little inconsistent. Many of them are giving me the answer on 1st April, B limited account debit to sales 1 lakh. On 1st April 24, you will purchase those goods. So purchases account debit to B limited 1.1 lakh. Another student is saying you will have goods 1 lakh debit, loss 10,000 debit to goods 1.1 lakhs. So this is what I am getting. Now, all of you gave the data as it is. Okay, means you have gone, I'm not saying it's incorrect, but you have gone on the form of the transactions. Form का मतलब क्या है? जैसा दिखता है वैसा account किया आपने. How it is visible, that is what you have done. You have not gone to the substance of the transaction. You have not gone to the substance of the transaction. मैं थोड़ा सा इस क्वेश्चन को चेंज करता हूं. I will just change the question a little bit. You will then be able to appreciate it. Let us assume that this A limited is actually Mr. A. Okay, I'm just modifying it. He goes to SBI. What Mr. A does is he wants urgent funds. SBI बोलता है ठीक है, I'll give you a gold loan. I'll give you a gold loan. So what Mr. A will do is Mr. A will pledge his gold and take a loan for rupees 1 lakh. Take a loan for rupees 1 lakh. 1 साल के बाद Mr. A will pay rupees 1.1 lakh and get back the ornaments that he had pledged. Get back the ornaments that he had pledged. So what is the work of the gold ornaments here? Very simple question, particularly all of you who said record sales and purchases again. Look at the second example. Mr. A took a loan from SBI against gold ornaments. He gave the gold and got a loan of 1 lakh, and after 1 year he paid 1.1 lakh and got back the gold ornaments that he had pledged. So my question to you is, what is the role of gold ornaments here? Are you selling the gold or are you giving it as a security? Are you selling the gold to SBI or are you giving it as a security against a financing transaction? What do you guys think? What do you guys think? Security. Everybody is saying it is a security. तो यार जब 1 मिनट भी आपने सोचा नहीं और जवाब सही दे दिया, so think of this also in the same way, no? I am selling goods to be limited for 1 lakh and I am getting back those goods. I was always using the word those goods. मतलब ये identifiable goods है. मैं जो गुड्स बेच रहा हूं वही गुड्स मैं वापस खरीद रहा हूं 1.1 लाख में. That means what? It is like saying 1 lakh of gold I have given and I am repaying it 1.1 lakh, 10,000 being the interest cost. So here also, my friends, can I not say that A Limited is taking a loan from B Limited of 1 lakh rupees today, and after 1 year it will be paying 1.1 lakh. That means 10,000 is the finance cost or interest cost for the year 23-24. Are yes or no? Can I say that the form of the transaction indicates sale of goods and purchase of goods, but the actual substance of the transaction is what? The substance of the transaction is A is taking a loan from B Limited and giving inventory as security. After 1 year, A Limited will pay 1.1 lakhs and then collect back the inventory from B Limited. Yes or no? So your inventory is merely acting as a security, आप वास्तव में in reality ना तो वो goods आप बेच रहे हो ना ही वापस खरीद रहे हो. You are only giving it as a security. This is not a lease back बेटा. ये लीज बैक नहीं है. इन अ लीज बैक ट्रांजैक्शन क्या होता है? You own an asset. You sell that asset to another party, and from that party you take it on lease. ये lease back नहीं है. This is a mere financing arrangement. मैंने लोन लिया 1 लाख का, सिक्योरिटी दे दिया इन्वेंट्री 1 लाख रुपीस का, एंड 1 साल के बाद मैं उसको पैसे देता हूं 1.1 lakh with interest of 10,000 and I get back the inventory. So this becomes my substance of the transaction. Risk and reward was transferred to the buyer, but in case of financing it is not. Absolutely right. Okay. So हमें क्या करना है? We have to go to the economic substance rather than the legal form. There are challenges. There are a lot of challenges. I agree, accept and acknowledge. 1st April 23 goods बेच दिया. सर वो GST रिटर्न में आया रहेगा ना, आउटवर्ड सप्लाईज. 1st April 24 को मैंने परचेस कर लिया तो हो गया ना वो इनवर्ड सप्लाईज 1,10,000. That is your GST law. Don't mix. That is why you and I, now it is a very specialized case. Okay. Now it will be a very specialized case. You cannot bring your GST knowledge, income tax knowledge. Sir, ऐसे account किया तो income tax will say this. ऐसे account किया तो GST department. Nothing doing. We have to look at the economic substance of the transaction. So what entry A Limited will pass on 1st April 23? The entry that A Limited will pass is bank account debit to loan from B Limited. This is 1 lakh. On 31st March, what is the entry that will be passed? Sir, the entry that will be passed on 31st March 23 is going to be finance cost debit to loan 10,000. And on 1st April 24, sorry, this is 31st March 24, and on 1st April 24, you are going to pass the entry. This is 31st March 24. And on this date, loan account debit to bank. 1.1 lakh. 1.1 lakh. Are you okay? Yes. Is it fine? Have you understood? Jagadishwar, most of the class I have kept it in English only, and what I discuss in Hindi I always repeat it in English. 98% of the session has been in English only. Okay. So what is happening is you are going to record the loan at 1 lakh rupees And after you record the loan at 1 lakh rupees, on 31st March, you will accrue the interest of 10,000, and immediately next day you pay the loan with the interest and get back your inventory. So what you are doing is you are only giving the substance of the transaction, not the form. What would be the form? The form would be recording sale of goods. You would pass entry B limited to debtor, B limited to sales. And then you would pass after 1 year purchases account debit to B limited. That is not right. That is not right. Correct, Vimal. That's absolutely right. Okay. So now this is the economic substance rather than the legal form. In fact, you have a number of Ind ASs that where you can see the application of this concept, very clearly. Ind AS 116 that deals with leases, for example. Classic standard that focuses on economic substance over legal form. The rent which you pay should actually be an asset and a lease liability. So it gives the mechanism of how do I convert the rental payments into leased asset and a lease liability. Suppose you enter into a contract for lease for taking a factory premises for a period of 15 years, 15 years. Now, when you enter into a long drawn contract for 15 years with rent increasing period after period, what the standard setters believed was you are probably unable to take financing. Reason may be anything. Either you are not passing the credit rating, for example, or there may be certain logistic issues. You do not have the address proof of the plant where you want to set up your factory. So for that reason, you have taken it on lease. But standard setters say, whatever be the scenario, kuch bhi ho, the fact that you are entering on a 15-year monthly lease contract means that effectively you are buying the property. And therefore, they will choose to treat the lease contract as an asset on one side, which is a right of use asset, because in that factory you can do whatever you want. The right to use that factory the way you want with reasonable restrictions, like you cannot do illegal activities. You cannot, carry out drugs or what you can say, fire weapons, etc. All those things you cannot do because that is against common law. But apart from that, you can do anything and everything. You want to manufacture goods, manufacture. You want to rent it out to somebody, rent it out. You want to sublet it. You just want to keep it idle, that also you can do as long as you pay the money. So you are having a right to use that factory premises the way you want for a period of 15 years, subject to monthly payments. If I had to buy a factory, I would do the same thing. Factory asset would come in my books. Liability towards the factory would be in my books, and monthly EMIs I would be paying. So therefore, the same concept is thought about in Ind AS 116, where it speaks about reflecting economic substance rather than legal form. Okay, so that takes care of economic substance over form. You can read this, what it means. Okay, go through these questions for homework. These are 2 questions, very simple. I don't have to do anything. Okay. All right. So fundamental characteristics, absolutely no relaxation in that. You have to ensure your financial statement contain relevant information, and the second one is reflect the substance over form. So applying the fundamental characteristics, identify an economic phenomenon, information about which is capable of being useful to users of the reporting entity's financial information. For example, Identify economic phenomenon, lease rentals for 15 years. Lease rentals for 15 years. This is the economic phenomenon. This is the economic phenomenon. Identify the type of information about that phenomenon that would be most relevant. So now what is the type of information? So what is your monthly lease liability? How much are you going to do? Okay, so all that gives the type of information, and finally determine whether that information is available and whether it can provide a faithful representation. Okay, so that is how you are going to apply the fundamental characteristics. Okay, all right. Next. I'll give a 5-minute break. Just let me continue till 8:30 and then we'll give a 5-minute break. Okay. So these are my basic features which you cannot compromise on. Which ones? Two. What are they? Relevance and faithful representation. Only these two. The next one is enhancing characteristics. These are going to give certain a touch up to the financial statements. They give certain additional information, certain additional clarity, but they are only enhancing in nature. So what is it? First one is comparability. Comparability means what? Your financial statements should be comparable with peers from the industry. So suppose you are Airtel, your balance sheet should be comparable with that of Jio, with that of Jio, with that of Airtel, with that of Vodafone. So that is how they should be comparable. So comparability means what? Compared with similar information about similar entities. So this is the first comparability. Second comparability is this year versus previous years. So that becomes your timeline. That becomes your comparability for another period or another date. So this becomes your comparability. The next one is verifiability. Okay, so verifiability means different knowledgeable and independent observers could reach consensus. Okay, so that is done. Verification can be direct or indirect, checking inputs to a model, formula, or other technique and recalculating the outputs using the same technology. So that is verifiability. Timeliness, you have to be punctual. You cannot say that March balance sheet I'll give in October, then lot of water has gone under the bridge, it's too late. So you have to be punctual. And understandability, classifying, characterizing and presenting information clearly and concisely makes it understandable. So these are your enhancing characteristics. Okay, so that is what you are having. So just go through this for homework. Very simple, nothing difficult. Okay, how am I applying this is what is given. So verifiability, for example, cash accounting. Comparability, disclosure of accounting policies, enabling comparison across different entities. Okay, then timeliness is there and understandability is there. So go through this. Okay, applying the enhancing qualitative characteristics. First one, maximized to the extent possible. Enhancing features should be maximized to the extent possible. And next one is enhancing qualitative characteristics either individually or as a group cannot make information useful if that information is relevant or does not provide a faithful representation. So what is the feature is that the enhancing characteristics should ensure that they give relevant information. they give relevant information. These conditions should ultimately go towards meeting those two. That is why we call it as enhancing. Enhance what? Relevance. Enhance what? Faithful representation. So these two things are going to be enhanced. Okay, so that takes care of applying the enhancing characteristics. It is an iterative process. Iterative means it is a repetitive process. Okay, so go through this. That's all about it. All right. Coming to the next part, that is cost constraint. कॉस्ट इज अ परवेसिव कंस्ट्रेंट. भाई बोलने के लिए तो कोई कुछ भी बोलेगा. एनीबडी कैन डिमांड एनीथिंग. ओके, फॉर एग्जाम्पल, suppose you are in the last year of the lease and now you have converged to Ind AS. So in the last year of the lease, do you think you want to do a full retrospective amendment? Answer is no. It's getting over now, so just jo bhi hai, expense it out and finish it. So that is one way of viewing the whole, scenario. So when a data set is required to be prepared, that data set you will prepare subject to what is the cost constraint. Subject to what is the cost constraint. Cost constraint means what? The amount I will spend versus the benefits that I will get. Is it justifiable or not justifiable? If it is justified, then we can take it. Okay. Both providers and users incur these costs. Both the providers and users incur costs in reporting and analyzing financial information. In applying the cost constraint, ICAI assesses whether the benefits of reporting particular information are likely to justify the costs. When applying the cost constraint in formulating a proposed Ind AS, expected nature and quantity of that Ind AS, in most situations, assessment are based on a combination of qualitative and quantitative information. So that is what it is. Okay. Because of inherent subjectivity, different individuals' assessment benefits of reporting particular items will vary. Therefore, ICAI seeks to consider costs and benefits in relating to financial reporting generally. So at any point of time, you cannot give them a data set. You cannot include it in the financials if it does not meet the cost constraint. Okay, cost constraint is what? Is it better to start digging compared to what is my this thing? Okay. Benefits of the reporting. Cost outweighs the benefits, ignore it and proceed further. Okay, so that takes care of the characteristics of the financial statements. And finally, we move to the objective we have seen, and then we start with financial statements and the reporting entity. Okay, so we take a 5-minute break now. I should be in a position to wind up the session by 9:30 max. Okay, so we take a 5-minute break right now and we shall continue at 8:35. Okay, we shall continue at 8 hours 35. Okay, yes. All right. So let's take a break. Till now, is it clear, everyone? Okay, guys, welcome back. So I hope the session is going on fine. It's a little theoretical. You may find it a little heavy because of that, but otherwise, I think it's quite manageable. Okay, so let me know if at any point of time you find things not comfortable, so I can see what can be done. Okay, so now coming back, when I talk about financial statements, what do I mean by that? Okay, that is also given in the conceptual framework. So when we talk about financial statements, they broadly cover three categories or three heads. One is financial position, the other one is financial performance, and the third one is cash flows. Your financial statements must furnish these statements or this data. So when I talk about financial position, it specifically means the balance sheet. When we talk about financial performance, it means statement of comprehensive income, that is the profit and loss. And when I talk about financial performance, it also covers statement of changes in equity. And finally, cash flows means statement of cash flows. All these are bound together by notes to the financial statements, which explains what are the accounting policies, what have you followed, how have you treated, all that is given. And apart from that, you can give supplementary schedules and information based on, derived from, or expected to be read with the financial statements, like management discussion, analysis, etc. All these are given. Yes, segmental information, disclosures about effects of changing prices, etc., etc. Okay, so this is what is the financial statements. And whose responsibility? It is the management's responsibility to ensure that this financial statements are prepared in this particular manner. Okay, now when we talk about a reporting period, भाई कितने टाइम के लिए बनाओ, for how long should I prepare it? So they are prepared for a specified period of time. What do you mean by specified period of time? In India, generally it is 1st April to 31st March. Please remember, this framework has been drawn from the IFRS. So they don't specify a period there. It could be July to June, Jan to December, or April to March, anything. So they say that it should be a specified period of time. It could be 1 year, 6 months, whatever it is. In India, generally it is for a period of 1 year. It is generally for a period of 1 year. To help users of financial statements identify and assess the changes and trends, provides comparative information for at least one preceding period. So that is also done. Is information about possible future transactions or events included in the financial statements? Answer is not exactly future, but some data is definitely included. Like for example, events occurring after the balance sheet date. Are you aware about the standard events occurring after the balance sheet date? Yes. I think we had that standard even under the AS regime. Yes, under the accounting standard regime, it must be some AS4, I think so, AS4 or AS4 only mostly. So you would be aware of events occurring after the balance sheet date. We would treat them as adjusting events or non-adjusting events. If adjusting, we would make the provision or take the entry as on 31st March. If non-adjusting, we would give a disclosure in the financial statements. So is it giving an idea of the future events and transactions? Answer is yes. But not all, only one or two, whatever is prescribed. Okay. Sometimes, or equity, so such information is included if it relates to the entity's assets, including unrecognized assets or liabilities or equity that existed at the end of the reporting period or during the reporting period or to income and expenses for the reporting period, and it is useful to the users of financial statements. So this data is given to you generally. Example, adjusting, non-adjusting. Example, to compute value in use, which is nothing but present value of future cash flows. So future cash flows are needed to determine the value in use prescribed under the impairment standard. So therefore, the future cash flows will be disclosed to you. The future cash flows will be disclosed to you. Okay. Coming to the next one, presentation perspective. They are viewed from the perspective of the reporting entity as a whole, not presented from the perspective of a particular group of users. It's a general public. Okay. Going concern assumptions normally prepared on the assumption that the reporting entity is a going concern. If an intention or need to cease trading or liquidate exists, financial statements may have to be prepared on a different basis. So when I say different basis, this is what it comes to. There is no Ind AS. There is no accounting standard that tells us financial statements of a company under liquidation. How should it be prepared? How should it be prepared? There is no accounting standard that prescribes it. So if there is no accounting standard that prescribes it, we come to the framework. Framework क्या बोलता है? Framework says that if there is an intention to liquidate, then you cannot prepare on a normal going concern basis. You will have to prepare it on a other than going concern basis, जिसको हम लोग बोलते हैं different basis. When I say different basis, what are you going to do? Sir, all assets, liabilities, typically they would start getting accounted at their realizable value. They are going to start accounted at the realizable value, and we would do the disclosures accordingly. Okay, because there is no other method of accounting which is prescribed under any of the accounting standards. नहीं है उसमें. So ultimately the flexibility comes up on us only to do the accounting. Okay, all right. Now, when we talk about the reporting entity, what are the financial statements that need to be prepared? So first one is parent and the subsidiaries. The reporting entity is the parent with the subsidiaries. So for that, we prepare consolidated financial statements. Consolidated means you must have studied AS 21. Yes, consolidated means parent and subsidiaries joined together to present as one economic entity. So that is your financial statements that need to be prepared, consolidated financial statements. The second case, reporting entity is the parent, that is a single entity. So you will prepare unconsolidated financial statements, or what we call as standalone financial statements, or what we also call as separate financial statements. No need for what you can say, no need for consolidation here, because this is a single parent standard that would be prepared, where investment in subsidiaries will come as investments. And then finally, two or more entities not at all linked by parent subsidiary relationships. You will be preparing combined financial statements. You will be preparing combined financial statements, which is very rare in practice. Okay, so that is done. Now we look at, sir, फाइनेंशियल स्टेटमेंट हो गया, रिपोर्टिंग एंटिटी हो गया, बट फाइनेंशियल स्टेटमेंट में आएगा क्या? What will be the elements of the financial statements? We completed what do you mean by financial statements, what goes in the financial statements, and we also saw what is the reporting entity. Now when I talk about elements of financial statements, it means financial position related, we have three: assets, liabilities, and equity. Financial performance, we have income and expenses. So what is the meaning of asset? An asset is a present economic resource. It is a present economic resource controlled by the entity as a result of past events. So it should be an economic resource. It should be controlled by the entity. It is a right that has the potential to produce economic benefits. So nowhere they say asset is property, plant, equipment, asset is inventory. No, it could be anything. It could be anything. Okay. So what is an asset? A present economic resource controlled by the entity. These words are important. We will discuss this. As a result of past events. An economic resource क्या होता है फिर? It is a right that has the potential to produce economic benefits. That has the potential to produce economic benefits. Are you able to follow? Yes? Yes. So I could be having a right for myself, which gives rise to an obligation for another party. Which gives rise to obligation for another party, like right to receive cash, right to receive goods or services. Okay, so these are what we are looking at. Next, right to exchange economic resources with another party on favorable terms. Okay, so these are the examples of my right, counterparty's liability or obligation. Whereas under the scenario of rights without a counter obligation, for example, rights over physical objects such as property, plant, equipment, resources, etc. Examples of such rights are a right to use a physical object or a right to benefit from the residual value of a leased object. Is it okay? Yes. Are we able to follow? What do you mean by asset right? Yes. Vanshika has confirmed. Anybody else? Just give me a minute. Somebody, 1 minute. Yeah, this is basic only. Okay, so that is why from your examination perspective, the topic is, you can put it somewhere like tier 2, second level importance. Okay, even if you get a question from the framework, it would largely be a theoretical question that could range anywhere from 4 marks to 6 marks. Beyond that, the likelihood of this chapter coming as a standalone question is very remote. So you can see somewhere between 4 to 6 marks. Generally, they will club it with some question. Like they will give you an Ind-AS question, and then below they will say also link it with the conceptual framework on financial reporting. So for that purpose, you are going to require the understanding of this chapter. But otherwise, ऐसे कुछ major There is no complexity in this. Okay. All right. So go through this for homework. What do you mean by right? See, all this presentation has come from your study mat only. So it's the same thing. Okay. So go through that. All right. Now, does having right mandate recognition of assets? Does having right mandate recognition of assets? Mandate means compulsory. Does having a right require recognition of assets? So the important takeaway from here is all rights are not assets. All rights are not assets. For example, to be assets of the entity, the rights must both have the potential to produce for the entity economic benefits beyond the benefits available to all parties. For example, see, consider a place like South Bombay. Okay, whichever city you people are, let us consider a very prime locality. Let us consider a very prime locality. And when we talk about a prime locality, suppose there is one hotel which is situated there, a very plush 5-star accommodation hotel which is situated there. The location of that hotel, proximity to commercial spaces, makes this hotel a very what you can say, a very niche property, and therefore customers are willing to pay a premium for that. Customers are willing to pay a premium for that. The property offers proximity to commercial spaces. The property comes with a river looking view or a sea looking view, whatever view you want, you see, mountain looking view, jo bhi ho, it is a very picturesque location. Okay. All the factors make this property a very prime property. And because of that, in the same city, you have hotels which charge room tariff about 15,000 per night. This hotel charges about 35,000 per night. And in spite of the huge price gap, people still come here to stay at this hotel, whether it be businessmen, families, whatever it is. So ye to ho gaya kahani. Now the question is, the entity is situated on that parcel of land which is in a prime locality. Now, because of its location in that, it is getting access of proximity to office spaces, good view, climate, etc. So in other words, it is having a right to enjoy the benefits of that location. Yes or no? Proximity to commercial spaces. Is it a right of this hotel? Yes. Because it is actually close by. So we can say that proximity to commercial spaces. Does it have good view? Yes. So it is having the right to all that. So now my question is, and these rights are giving higher tariff, it is giving higher rates per night, and because it is giving higher rates per night, there is a potential to generate economic benefits. There is a potential to generate economic benefits. So now the question comes, ye right hai. My right for proximity to commercial spaces, the right to be in a prime location, I have the property documents. All these rights are translating into potential economic resources inflows in the future. So now the question is, does this right qualify to be accounted as an asset in the balance sheet? Does this right qualify to become an asset in the balance sheet? Think and answer. Don't look at the screen. Think and answer. Don't look at the screen. Okay? Think and answer. I'll close the screen so that you can discuss. Think and answer. I have this hotel which is situated in a prime locality, and this hotel is having access to commercial places, blah, blah, blah. And because of this, a normal hotel, which is about 15,000 per night tariff, this hotel charges 35,000. So it has a right for proximity to that, which is translating into a potential economic benefit by virtue of high tariff. My question to you is, the right of proximity to commercial spaces. Proximity मतलब नजदीक, आप कितने नजदीक हो commercial spaces के, वो आपका right हो गया. The right to good views, the right to picturesque surroundings, all these rights are translating into higher income. So that is potential inflow of economic resources. So now my question is, these rights, should I record them as assets? If yes, why? If no, why? Okay, think and answer. Think and answer. Thank you, Pooja. Yes. Okay, Vanshika, Vimal, Pooja, Krishna, Swati, Tanisha, Mansha, Mohammed. What do you guys think? Shankar, Charu, what do you think? Yukta, Yukti, what is her name? Yukta. Yes. Ashu Goyal, Shailesh, Viraj Desai. Yes. What do you think? Should I account for those rights as an asset? If yes, why and how? If no, why and how? I haven't come to measurement as yet, Charuji. I haven't come to asset, to valuation. So let us not get into valuation. Apart from that, why we cannot record? Okay, so Shankara has given a good answer. Okay. Now, when we talk about an asset, it should be a present economic resource controlled by the entity. These 4 words, controlled by the entity, controlled by the entity, controlled by the entity, means it is highlighting an exclusivity. It is highlighting an exclusivity. You should be having the exclusive rights to enjoy this particular asset. The benefits from this asset should flow to you. Not only that, control means the benefits should flow to you and it should not flow to the others. That is the meaning of exclusivity. That is the meaning of exclusivity. So therefore, the proximity to commercial spaces, hey, that right is there for you. But वो right तो सबके पास है. That right, anybody else has. Suppose a plot next to you is vacant and somebody comes and puts up a hotel there. That hotel also can say, this is also my right. So now, is there an exclusivity that is there? Answer is no. There is no exclusivity because the right of proximity to commercial spaces is not controlled by you. Suppose, let us take the case of a place like Nariman Point. Years ago, Nariman Point was the hub of commercial activity. So my proximity to Nariman Point or my hotels in Nariman Point had a very premium pricing because of proximity to commercial spaces. But now the commercial spaces are all moving to Bandra Kurla complex. Many of them already have. So the value of South Bombay Nariman Point is little bit reduced because BKC is becoming another hub in Mumbai. So if BKC is becoming another hub in Mumbai, could I control the shifting of the commercial spaces to BKC? Answer is no. So when you are not able to control what happens around you, When there is no exclusivity which happens around this asset, then it's not your asset in the first place. Because for asset, the most critical element is control by the entity. Control signifies what? Only I can enjoy the benefits and I will not let others enjoy the benefits. Only I can enjoy and I will not let others enjoy the benefits. Suppose you have a car. That car is your exclusive, what you can say, it is giving you exclusivity. It belongs to you, only to you. Whenever you want, you can use it. So that becomes exclusivity. The right to take a cab is there with you. It is there with, say, Shankar also. It is there with Charu also. It is there with Pooja also. It is there with me also. Is it an exclusive right? No. So if it is not an exclusive right, how can it be an asset? So for asset, it should be a resource. A resource is a right, but that right should be an exclusive right. That right should be an exclusive right. Okay. Suppose you have a what you can say, you have a building, and the building is situated right at the base of the flyover. It becomes a commercial hub of activity because all the vehicles converge on that. But suppose if it is situated earlier when flyover was not there, but then a flyover came and now all vehicles are going on the flyover and your commercial premises starts getting poor footfalls because of the flyover. Can you stop the construction of the flyover? Answer is no. And therefore that exclusive control cannot be exercised, and therefore it cannot be an asset. It cannot be an asset. ठीक है? सबको समझा? Yes. Did you understand? Hotel is controlled by the entity, but the right for the view is not controlled. वो तो you put another hotel next to you, you can also enjoy the same view. You are close to SBI. It is a right. That proximity is the right for you. But another hotel next to you also can say SBI is close to me. So therefore, it's not exclusive to you. Okay. So when I talk about elements of financial statements, rights available to all parties without significant cost. Without significant cost. For instance, access to public goods such as way over land or know-how in the public domain are typically not assets for the entities that hold them. They are typically not assets for the entities that hold them. Similarly, an entity cannot have a right to obtain economic benefits from itself, obviously. That is why debt instruments or equity instruments which are purchased or bought back should not be regarded as assets. Should not be regarded as assets. Okay? All right. Next, should each right be recognized as an individual asset? Principally, yes. But for accounting purposes, rights are all bundled, aggregated together and recorded as a single unit of account. Okay. Example, legal ownership of a physical object may give rise to several rights, including right to use, right to sell, right over the object, right to pledge, and other rights not listed. So in all these cases, you have an asset, you have these rights. Ideally, I have to split it, but we don't do that. We don't do that. Yes? All right. Vimal, I hope you are clear. Okay. All right. So go through this homework. I'm leaving a lot of examples for homework because they are doable. Okay. All right. So asset, you need a right. Is probability having any role? It does not need to be certain or even likely. I gave you the examples of a debtor who has gone under liquidation. Yes. Is that debtor who is under liquidation liable to pay the money to you? Yes. So for you, technically speaking, are you in a position to collect from him? If he was not under liquidation, yes. But now because he's under liquidation, the amount that you can collect will probably come with a haircut. But the important point is, you are probably having a very remote possibility of realizing it. But the framework says we never speak about probability. It may be remote also. A right can meet the definition of resource even if the probability that it will produce economic benefits is low. It will produce economic benefits is low. Okay, so probability we don't look at. All we see is, do I have a right? Do I have an exclusive right? And does that right give potential economic benefits? That's it. We never go into the what you can say probability of the economic benefits. Okay, so that takes care of role of role of probability. Timing. Timing, although an economic resource is derived, the resource is the present right that contains the potential. It's not a future economic benefits that the right may produce. It's only a present right. It's only a present right. And finally, role of expenditure. Close association exists between incurring expenditure and hiring assets, but it is not necessary. Example, assets received by way of grants. Donations meet the criteria of assets even though expenditure is not incurred. Okay, this is the bankrupt customer example. Go through it for homework. Okay, and finally, what is important is control. What is important is control. So much so that they say that if one party controls an economic resource, no other party controls that resource. You cannot have multiple controls. फिर वो control नहीं होगा, वो झगड़ा हो जाएगा. It will end up being a quarrel instead of control. So one party only can control. All right. Okay, when we talk about a liability, what is a liability? There is an obligation to transfer an economic resource. And what type of obligation it is? It is a present obligation as a result of past events. It is a present obligation as a result of past events. Okay, all right. So that's all. That's what is explained in detail. Nothing specific. Again, here, do we look at the probability criteria? Answer is no. Even if probability criteria is low, we still go and record the what you can say. We still go and record the liability. We don't look at whether it is probable or not. Okay. Next. Okay, so obligation is to transfer an economic resource. So that is done. That completes liability. Go through all these slides for homework. I don't have much to add on this. They are easy to understand. Okay. So go through these questions. Okay. Now we come to the next two components, that is income and expenses. Income and expenses. And finally, I will be taking up equity. So they have given a very beautiful word of income, definition of income and expenses. Income is increase in asset, number one, or decrease in liability, number two, that results in increases in equity. This is number three, other than those relating to contributions from holders of equity claims. Other than those relating to contributions. That means what? That means okay, that means you receive income, it increases your assets, number one, or you receive income directly in a liability account, liability goes down, so your income goes up or liability goes down. Second one, other than equity contribution, other than equity contribution. Is it okay? Yes, all clear? What do you mean by expenses? These are decreases in assets increases in liabilities that result in decrease in equity other than those relating to distribution to holders of equity claims. So for example, dividend. Will it come under this definition? Answer is no, because dividend is typically a distribution to shareholders, and that is why it cannot come here. So this is your income and that is your expense. And coming to the last question. One second. Okay. I'm coming to the last liability. Go through. Okay, I'm coming to the last definition, that is of equity. Okay, so when I talk about equity, it is nothing but residual interest in the assets of the entity after deducting all its liabilities. It is the residual interest in the assets of the entity after deducting all the liabilities. So total of assets minus total of liabilities, that becomes your equity. So nowhere have they said equity share, voting rights, this, that, etc. All that is not given here. Okay, so that takes care of the elements of your financial statements. Anybody has any doubt so far? Anybody has any doubt so far? Anybody has any doubts? Okay, fourth point of income. All right. Fine. See, I'm just explaining in a simple way. I have my profit and loss account. Yes, I have my profit and loss account. So ultimately, I have a net profit figure here. Where does this net profit go? This goes to retained earnings, correct? This retained earnings typically is going to be under my equity because it is a reserve. So is this net profit increasing my equity? Yes. And therefore it becomes income. But sir, suppose I talk about equity includes equity capital and retained earnings also. So here also you will be having equity capital. Okay. Whatever it is. Now when we talk about equity, can I do a fresh issue? Yes, I do a fresh issue. And because I do a fresh issue, can I say that equity has gone up? Can I say that equity has gone up? Yes. But infusion of equity, is it income? Infusion of equity, is it income? Particularly Mrs. Charu, could you please answer? First case, I told you equity went up because net profit moves to retained earnings. Second case, equity has gone up because of fresh issue of equity shares or further issue of equity shares. So my question to you is, what do you think? Is this equity infusion income or not income? Yes, it's not. And therefore, all items of income which increase the equity other than fresh infusion or contribution, is becomes my income. A very, very beautiful definition. Expenses will be totally opposite of that. All items which reduce, okay, all items which reduce the equity other than distribution of dividends, etc. So that becomes your second this thing. Okay. Now next one. Sir, expenses में जो last था other than shareholders distribution. Explain again, sir. Okay. All right. वो करते हैं. We'll do that. Yes. So let us start with any expense. Okay. Where does this expense get accounted? Sir, this goes to the P&L. And from the P&L, where do you want to take it? Where do you want to take it? Okay. From the P&L, it ultimately goes to retained earnings. Forget income now. It ultimately goes to retained earnings, and retained earnings, it will be negative because expenses have a debit balance, retained earnings have a credit balance. So this is going to be a negative. This is going to be a negative. Okay. Next one. Suppose I declare dividends. Is this going to reduce? Is this going to reduce equity? Obviously, it will reduce equity. Obviously, it will reduce equity. Because it reduces equity, tell me, the dividend which is declared, is it an expense or not an expense? I'll explain, Shankar. Just let me finish this. Then I'll just explain your answer. Okay. Is dividend an expense or distribution to equity shareholders? What do you think? Yes. Pooja, distribution of dividend, is it an expense or is it not an expense? It is not an expense. It is not an expense. Why, sir? Because it is a transaction with the owner in his capacity as owner. It is his transaction with owner in the capacity of owner. So is it expense or not? It is not an expense. But if it is not an expense, in spite of that, is my equity going down? Is my equity going down? Yes. Is my equity going down? Equity total means equity capital plus reserves, etc. altogether. Is it going down? Yes. So it is going down in spite of a fact that it is not an expense, and therefore the definition flows like expenses are decreases in assets or increases in liabilities, decrease in assets or increase in liabilities that result in decrease in equity other than those relating to distributions to holders of equity claims. Okay, of equity claims. So anything which reduces equity other than these one-off items which we have already recorded, that becomes your this thing. Okay, next. Anybody has any doubts? Yes. So that is why Pooja, the definition of income flows like that. Okay. Now next one is, sir, can you explain with an example for increase in assets or decrease in liabilities? Very simple. Let us assume you have sold goods on credit. Let us assume you have sold goods on credit. So therefore, what entry are you going to pass? Debtors account debit to sales. Okay. So can I say that by virtue of this transaction, my debtors have increased? Yes or no? And when debtors have increased, can I say that my assets have increased? Yes. Yes. Assets have increased. Yes or no? You have trade receivables in your place now. Assets have increased. Done. So that amounts to increase in asset. Yes or no? That amounts to increase in asset. Done. So I got a new debtor in the place. So assets means assets increase. So therefore that becomes increase in assets. Increase in assets came at the cost of a t-shirt. Done. Shankar, did you understand? Done. Shankar, I'm waiting for your answer. Decrease in liability will be the opposite of this. Decrease in liability will be the opposite of this. Okay, decrease in liability. Suppose you have an overdraft or a cash credit facility. So cash credit facility may you have 10,000 rupees credit. Now you are telling your debtor to put the money directly in the cash credit account. So debtor will do that. So what entry are you going to pass? Cash credit account debit. Okay. Next, to debtors. Can I say that the balance in the cash credit has dropped down? Cash credit is a liability account. Liability accounts have a credit balance. By virtue of the payment made by my debtors, can I say that my cash credit has fallen down? And since the cash credit has fallen down, can I say that it is an... Okay, one second. Okay, we'll not keep it as debtors. We'll keep it as income only. Normal service income. I have received service. Okay. I have received revenue. So I told the depositors to deposit the money in the cash credit account. So money is all deposited in the cash credit account, which becomes my income. So therefore decrease in liability, cash credit facility account debit to income. Ignore this. Don't club this and that. Okay. All right. Shankar, did you follow? Yes. Shankar, okay. Suppose you are running your business. Okay. Suppose you are running your business. Suppose you are running your business. You have a cash credit account with you. This cash credit account has a balance of 10,000 payable to the bank. Now you are doing some business, and as part of that business you have told your customers to deposit the money in this account. You've already made the sale before. You have already made the sale before, but you are now going, oh sorry, you have not made the sale before. I'm sorry. You are now making a sale, and pursuant to that sale you tell your customers, please, the moment I generate the invoice, make the payment, and payment you route it to the cash credit account. Let us assume it is a CA firm. Okay, so CA firm has a cash credit account of with a 10,000 credit balance. It is issuing invoices pursuant to the services it provided, and it tells the clients to immediately deposit the money in the cash credit account. So what entry will be passed? Cash credit account debit to cash credit account debit to income from professional. Correct, no? To income from professional services. 10,000. Suppose the invoice price is 10,000. So the money will be deposited in the cash credit account. Cash credit balance was 10,000 earlier. Now it becomes 0. So can I say that my cash credit liability has reduced? Can I say that cash credit liability has reduced? Yes or no? Can I say that CC liability has reduced? Muhammad, cash credit is a liability, so it has a credit balance. You provided some services, they made the payment directly to the cash credit account. So therefore, can I say that this is a decrease in liability? Yes, and that is why income is that item which also leads to a decrease in liability. Okay, sir, distribution of dividend will reduce equity, but how? Arey wo P&L appropriation hai na, it is a P&L appropriation. So ultimately what are you going to do? You are debiting retained earnings and crediting debiting retained earnings and crediting what? Cash bank. This is dividend. Retained earnings sits under equity. This whole transaction is dividend distribution. So if retained earnings is going to get debited, that means what? Equity has a credit balance. From that credit balance, something you are debiting, and therefore it creates a what you can say, it creates a reduction in equity from dividend distribution. Yes. Charu ji, did you follow? Distribution of dividend is ultimately debited to the equity. So I hope that it is understood. Dividend will never go to the P&L. You can call it retained earnings or what you used to call it as P&L appropriation account. Ultimately, the reserve balance reduces because that's what you are paying to the shareholders. Okay. So that takes care of this anyways. So financial performance. Okay. Recognition is the, okay. So now we move on to recognition and derecognition. Very small topics are left now, nothing major. So when I talk about recognition, it is the process of capturing for inclusion in the balance sheet or P&L an item that meets the definition of one of the elements of the financial statements. That means asset, liability, equity, income or expenses. The amount at which an asset, a liability or equity is considered in the balance sheet is referred to as its carrying amount. Okay. So whatever is appearing in the balance sheet, we call that the carrying amount. Amount at which an asset, okay, recognition links we are having, you can go through this. For recognition criteria, don't forget the two fundamental characteristics. One is relevance and the other is faithful representation. ये भी ध्यान तो रखना ही पड़ेगा अपने को. Okay. So this one go through for homework. Go through this for homework. Okay. I want you to go through illustration 1, particularly interesting. Okay, and illustration 2 also. Most of these we have done, so therefore you should not find any difficulty in that. Okay, coming to the next one, measurement. You are given an option under the framework. You can follow historical cost or current value. Current value is required for this also. Okay, historical current value. Current value can be further classified into exit value and entry value. Exit value, you have fair value and value in use. Entry value, you have the current cost. So these are the broad measurement basis of an asset or a liability. Measurement basis of an asset or a liability. So what are you going to do? Okay. And then you have illustrations. So go through this. Okay. Next. Next. Okay. All right. ये हो गया. This also you do it for homework. All right. Factors specific to initial measurement. Transactions could be at market terms or off market terms. Off market terms, we have a huge discussion in financial instruments. Okay. So off market terms. Okay. Off market transactions. That means transactions which are not at market price. Transactions which are not at market price, they have given. And what to do in case there is more than one measurement basis. In case there is more than one measurement basis. Then this thing. And finally, presentation and disclosure objectives. What do you have here? Balance is needed between relevant information and requiring information that is comparable. First one. Second one is effective communications is financial statements is also supported by considering the following principles. Entity specific information, duplication of information, etc., etc. Okay. Effective presentation and disclosure achieved by proper classification, and whatever multiple line items are there, you can club them under one head and do the this thing. Do the presentation. Okay. So that takes care. Please go through these examples by yourselves. Okay. Please go through these examples by yourselves. This is for homework. All right. And finally, we come to concepts of capital and capital maintenance, where you have two types of capitals. One is your financial capital, that is what you and I have been continuously doing. And the other is a physical capital. Physical capital meaning what is your operating capacity or what is your productive capacity. So these things you are going to have a look at. So just go through these questions. See, basically when we talk about capital maintenance, it starts with opening balance, whatever it is. Closing balance should at least come to that. Okay, closing balance should at least come to that with all the adjustments that we had suggested. Is it okay? Yes. If your opening capital is high, lower closing capital is less, then that means you haven't been inefficient. Okay, you haven't been efficient, you have been inefficient. Okay, if other way around, you guys are doing great. Okay, so that takes care of this. Go through this. I don't need to solve these questions, you can do them by yourselves. Okay, so that takes care of capital and capital maintenance. I don't really have much to say on that. Anybody has any questions? Anybody has any questions? Anybody has any questions? Charu, Vimal, Tanisha, Mansha, Muhammad, Shankar, Vimal, Tanisha, Krishna, Swati, Rajiv. Any questions? Can you promise me that you will undertake this capital maintenance? Yes. Concepts of capital and capital maintenance, two types of capital. Basically, you look at opening capital and closing capital should be the what is reconciled. Okay, so that is what you will have to do. Okay. All right. So great. I understand and appreciate that the chapter would be a bit heavy even for me. While teaching a pure theoretical chapter, it starts to get a little heavy towards the end of it. But I'm sure that you are taking a lot of things away from this topic, and I promise you that the next topics which are going to come, the next chapters which are going to come from our side will be a very, very practical and very interactive and very informative topics as compared to this. So yesterday and today, I suppose you had just a mere introduction to the topic as such. You did not have the standard core. So the core standards will start from tomorrow onwards. Okay, from tomorrow or day after, maybe, whatever be the case. So once they start, I'm sure that you will be in a position to appreciate the chapters more and more. It does get interesting. It does get interesting. And next one, this is a very preliminary elementary topic. Okay, so starting with definition of assets, this, that, everything. So from that perspective also, some of you may have felt, I'm not sure, some of you could have felt a little disillusioned, but let it be. It's just the initial phase. The next set of sessions which take off from the next class, I'm sure they will pose a lot of challenge to your thoughts and to your brains. Until then, stay safe. Okay, stay safe, study well. Do reach out to us for any doubts that you have. Don't hesitate even a little bit. Okay. Shiv Jyoti Thakur, we will be uploading the presentation on the portal from where you can download it from the BOS app. Okay. So there you will have all the notes. So from there you can get it. Acha. Charuji, a general question is there. At what time should we register in the final? Before 1 year or 6 months or with articleship? I think suppose now the articleship requirements have been modified. So you get your articleship period for 2 years only. 1 year initial and then 1 year industry, and if you want to work under a practicing, if you want to practice another 1 year, so in toto a 3-year tenure of articleship. So if you are going for the 2-year regular articleship, then probably it would make more sense to register and then join, so that you get the study mat and you can review the same accordingly. Okay. Can we get the study material from BOS now? Actually, I got the new copy just yesterday. I had placed an order. So I think they are already out now. So you can place your orders for the same. And also you can, get your, if you have the coupons, against the coupons, you are getting the study material entirely. So you can start getting it. Okay. Yes, they are available. You can check. If you are a fresh student, the coupon will be there. If you are an existing student, I think you may have to buy. I'm not very sure how that works. Okay. So with that, we close for today. Tanisha, thank you. Vanshika, thank you. Yes. Vimal, I hope the numbers don't go down in the future. We are counting upon you. Numbers should not go down at all in the future. They should remain as it is. Shiv Jyoti, everyone. Yes, you should remain there. Vimal, Kishore, Mohammed, Pooja. Who else is there? Tanisha, Jagadishwar Reddy. और कौन है? राजीव, विराज देसाई, शैलेश माने, आशु गोयल. I hope it's all okay with you. All right. Thank you. Okay, sir. Thank you. And we'll catch up on the, I think my next session is on 5th October on the revenue standard. Very interesting standard, very, very detailed and very informative. So I look for teaching that standard to all of you. Okay. See you guys. Take care. Bye-bye. End of today's class. Thank you.